take a look at it, let me go and I'll just simply show you. If you take a look at it, here we go. So I'll start with the upper left-hand side and then I'll back into your question, David. The upper left-hand side is the holding company. It's actually owned by your estate structure. It would be owned by you and your spouse. It would be owned by a family trust. It would be owned by the trusts of your kids. It would be owned based on whatever your estate planning objectives are. That's the actual ownership. But if you take a look at the third line, the manager is Talking Dog Management Corporation. So it's managing it, but to the extent that, and this is where you'll really see it, the holding company owns the real estate company. The holding company owns the investment company. And again, I'm just going to use enterprise company to distinguish it from a practice. And the holding company owns the enterprise company. All of that, whatever that wealth accretion is, all flows up to the holding company. So that over the course of your entire lifetimes, all of that flows up to, in this case, Talking Dog Holdings, LLC. Back to David's point, the management company, Talking Dog Management Corporation, is the management company. It will never build assets. It is an instrumentality and a modality only. You don't buy any assets with it. You buy assets through your various entities. You don't buy assets through Talking Dog Management Corporation. How does it pay its bills? It will take whatever the distributions are, whatever the fee structure is. I use infrastructure services agreements to provide that there is an upflow of a certain amount of fees to Talking Dog Management Corporation, equivalent to whatever the amount that's going to be paid out is, so that at the end of the year, it has no income. It has expenses that have zeroed out the income, so it never produces a tax liability. And on top of that, it doesn't have any assets. However, every single contract that gets signed as Talking Dog Real Estate LLC by Talking Dog Management Corporation Manager, Talking Dog Investments LLC by Talking Dog Management Corporation Manager, and so forth and so on. So it is what David just described. It is the front-facing company that is in the line of fire. And the front-facing company in the line of fire does not have any assets to fire at, because all of the assets are actually in the names of either the SPVs, the real estate, the investment, the enterprise companies, or those companies being owned by the holding company. One final thing I'll say about this slide before we move on. Also know that Talking Dog Holdings doesn't own assets directly. It owns entities which own assets. Why? Because you want to remove any opportunity to have the breadbasket of your assets in some way subject to a line of fire. So you would never want it to own an asset directly. You would want it to own the entity that owns an asset based on the type of asset that it actually is.
Larry, are you going to touch on now or perhaps later, if so, that's fine, the nuance of having multi-member LLCs?
No, I can do that now.
Okay.
And I'd be glad to do that now. By the way, let me make one final comment and then we can do that. So the only final thing that I'll say is, on top of that, if we have asset protection and estate planning, both of which are implicit in this slide, the final objective that you want to be looking at is the simplification and the unification of tax payments. So what do you want to do? You're maximizing Talking Dog Management Corporation by allowing it to be a C corporation. The only disadvantage to a C corporation is double taxation. So you don't want to do double taxation, or you don't want a C corporation if you got doubly taxed, except that Talking Dog Management Corporation doesn't have any income. So it's not going to have any tax liability. So You use a C corporation because it gives you more deductions than an S corp will give you. So you maximize your deductions in Talking Dog Management Corporation. In Talking Dog Real Estate, Talking Dog Investments, Talking Dog Obedience Training, all of those will flow. You'll maximize the deductions in each one of those. And then whatever is left over would automatically flow up and be consolidated into Talking Dog Holdings, LLC. Why? We'll take a look at it. It's 99% owned by Talking Dog LLC. So it files and it flows up to Talking Dog Holdings. It actually gets paid there, or based on the structure of the estate you have here, it flows down into the 1040 of the grantors of these trusts. So you only pay tax on just that one level. So you're simplifying the tax payment structure. You're providing a flow so that you're maximizing at every level, so that whatever you have left is the only place that you're going to actually be paying the taxes themselves. To David's point, he said, David's question was, am I approaching it from the standpoint of multi-member? We don't do single member LLCs. We would always do double member or more. So in the holding company, it's irrelevant because you have multiple members anyway. That's your entire structure of your estate plan. Therefore, if you'll notice, Talking Dog Management Corporation doesn't own anything in Talking Dog Holdings. It's just simply the pure manager. In each of these others, in order to make sure that it is at least two members, not a single member LLC, we give 1% to the manager. So Talking Dog Management Corporation owns 1%. Talking Dog LLC owns 99%. The difference between the two is the difference between an LLC and a corporation. In a corporation, you can attach the stock. In a single member LLC, you can attach the membership. In a multiple member LLC, the most you can do is get a charging lien against distributions that are being sent out of the LLC, but you can't touch the membership interest of the LLC. So it provides an additional level of protection internally. For people who, not understanding that, create their LLCs in a way where they become the single member, thinking that they're somehow protected because they have an LLC, it's not helpful to them. And as a result of that, let me move this again. As a result of that, they didn't achieve the asset protection value that they wanted to get through the LLC. So is that clear, David? Does that make sense?
Yeah, thanks. That comes up from time to time too. So thank you for that clarification. Perfect.
Okay, so let's just look at it just really cleanly without a lot of that noise. You have to the left, you have Talking Dog Holdings. It's owned by your estate in whatever structure you would want to put it together. And it's up to each individual family how they want to structure it. But that's what the structure is for the holding company. And then you have each one of those entities that I just described. You have Talking Dog Management Corp, Talking Dog Real Estate, Talking Dog Investments, and then Talking Dog Obedience Training. Now, here is an additional element to this that I want you to just understand. You have what you see here are SPVs, and some people call them SPEs, it doesn't matter. It's a special purpose entity or a special purpose vehicle. So the comment that I used before, or the answer to an observation that David had said is, take a look at Talking Dog Real Estate LLC. One of those SPVs, and I've certainly done that for Freedom Founder members, is if they have a lot of real estate, I will do the Talking Dog Real Estate LLC. I don't call it Talking Dog, however, and I will create an SPV for their syndications. And if they have a good, strong category of assets in another asset category, I'll create another SPV specifically for those particular assets. So The SPVs that you create under each one of these are broad categories. The SPVs are really just a combination of what makes sense, what's practical, what's necessary, but there's no magic to it. You can have as many SPVs as common sense and business and investment suggest would be appropriate. The important thing here, though, is that you're using it, as I described in one particular discussion that I had with one of the members. What you're doing is you're creating a cogent plan. The idea is that you want cogency in your financial structure so that you understand it. Number two, your family understands it. Number three, that you can use the structure to manage your assets without breaking a sweat. And that's the type of cogency that you're looking for. I have seen a number of financial plans, and in those plans, it's kind of like I pull my hair out trying to figure out. They're all over the place. There are some assets which are owned by individuals, others by spouses, husband and wife, others in some entities, multiple entities for multiple assets. They don't relate to each other. This is an integrated structure, and it allows you to integrate the assets in a way which is functionally cohesive, and which allows you to therefore create managerial efficiency in the process. Okay? Now, with that said, and if that becomes the primary structure, there are a couple exceptions to that. And by exceptions, I mean that there are just some things that don't really belong inside this structure for very specific reasons. So let me just identify what those exceptions are now. For your personal residence, there is no reason whatsoever they should be in an LLC. The best ownership of a personal residence is as a homestead, if you're single, or as a married couple, if you're husband and wife. So personal residence, I don't put anybody's personal residence. I don't put it in a trust. I don't put it in an entity. I just allow them to own it either individually because it is their homestead, or jointly if they're dealing with a married couple. Same concept for personal operating bank or brokerage account. It's, Dr. David and Mrs. Phelps, and you own the account. You're on it jointly. Were something to happen to either party, there is no, the other party owns it 100% because it's an entirety. So if it's a husband and wife, it's an entirety. If it's if it's a 90-year-old mother and her daughter who's taking care of her, it's jointly. You don't want to have to probate it in order to be able to pass the bank account. So you want it to just simply be owned jointly. So joint ownership for operating bank or brokerage accounts. Life insurance policies, not a good idea to put those in companies. A life insurance policy is a very effective vehicle for being able to fund things that happen when a person passes away. And you want to have easy access to it. So who's the beneficiary? It's the spouse or it's an intended beneficiary. You have a life insurance policy for your son, a life insurance policy for your daughter, a life insurance policy for your grandchildren. You want the opportunity to be able to have those proceeds move very rapidly through the system. When I'm representing somebody who has passed away, and I'm helping the spouse clean up the estate, there is nothing better than you provide a certified death certificate. You provide a copy of the life insurance with a designation of beneficiary, and you get your check within 14 to 21 days. It's done. You start providing an intermediary entity. You now have to go through 22 different hoops before the life insurance carrier is going to cut a check to a particular entity that's involved. You don't need to do that.